Last night we had our Bookwalter takeover where we presented a lot of new information to our investor group. And one of the most popular pieces in that presentation was why out of the past 15 years, now is the best time to invest in multifamily. And we wanted to share that with our investor group. So we're recapping right now what we shared there. And it really comes down to what are the multifamily market conditions that are making it a great time to invest in multifamily apartments. And to kind of tell this narrative, we started off with the picture of the 5-year US Treasury, because I think this really highlights the journey that we've gone through over the past 15 years. Started back in 2007, we had the Great Financial Crisis. Leading up to this, there was a ton of new home construction, apartment construction. There's a lot of subprime lending and exuberance around owning not just your first home, but your second or third home, vacation homes, and anyone that could fog a mirror was getting a loan. And that created a artificial amount of demand that bolstered home prices, and eventually that bubble popped. And what happened was the biggest recession we've seen since the Great Depression. It's kind of hard to remember back then, but there's entire new developments that were sitting vacant with nobody to buy these homes. And what happened was, yes, we saw a decrease in the price of homes. A lot of people started moving into rental units, but importantly, this led to a lot of developers, both on apartments and single-family houses, going out of business. A lot of trade workers went and they found new jobs because there wasn't enough work in the construction business. And that resulted in a sustained period of underbuilding of housing. Now, this wasn't an issue for close to a decade because the millennial generation, which is the largest generation since the boomers, we're starting to reach peak household formation ages, and a lot of that oversupply was being absorbed as millennials started buying houses and also moving out of their parents' houses and renting their own apartments. So what we saw really from about 2012 up to 2020 was sustained demand for new housing. Rents were increasing. Anyone who's buying single family, duplex, or apartments in this period were doing quite well. It wasn't crazy though. That all changed when we had the pandemic hit. March of 2020, everything shut down and there was kind of a freeze in the market. Everyone's trying to figure out what are we doing here. But pretty quickly, people got tired of living with their roommates. They saw that maybe remote working was something that was here to stay. And there was an explosion of new housing demand, both on the single family housing and on apartment rentals. And I think we all saw this. Housing prices were jumping, rents were increasing double digits per year. And this exuberance and demand appetite was coupled with what we can see here. The 5-year US Treasury and really borrowing costs were dropping down to almost zero. And so what this created was an entire froth and demand in the multifamily market. People were seeing revenue growth numbers increasing, and the less responsible sponsors and investors were projecting that out as a long-term trend, even though it was a short-term condition. But they could also borrow at dirt cheap money. So everybody was making money during those, quarter after quarter valuation growth. And that happened for about 2 years until we had the transitory inflation period, which we thought would be temporary. I thought it was going to be temporary at the moment, but the reality was that the Federal Reserve had to jack up interest rates by about 500 basis points, 5%, in just a couple quarters to tamp down inflation. Anybody who knows anything about asset prices, they're inversely correlated with interest rates. So when money is cheap and interest rates drop, you're going to see the stock market appreciate, you're going to see real estate appreciate, and likewise, when you have the cost of capital, interest rates increase, values drop. And this is exactly what we saw in 2022. It froze the market. If you weren't in the real estate commercial space, it was a full-on depression. Transaction volume dropped 80%. And, as Warren Buffett says, when the tide goes out, you see who's swimming naked. There's a lot of distress in the market. A lot of that's kind of been deferred, but really we've just seen straight up a 30% drop in asset values. And the issue right now in the industry is that anyone who doesn't need to sell is not selling. Why? Well, we talked to a apartment owner last year. We really liked his property. He wanted to sell, but we offered him a price that was realistic for the current market. And he, very good guy, straight up candid, said, guys, a year ago, I was getting 3 calls a day. My phone was ringing off the hook. I think the interest rates are going to drop back down, and then I'll sell then when I'm back, on the hot commodity on the market. We said, okay, we understand that. We can't make a deal happen right now. Maybe we reconnect later when things hopefully normalize out. In 2024, we all thought, the Fed started dropping rates. We thought interest or inflation was tamped down, and we might not go back to the obviously 2021 cheap cost of capital era, but maybe back down to what we've seen for the past decade or so. The reality is that has been postponed. Inflation is a bit more sticky, and we have certain federal policies on tariffs and other things that might keep interest rates higher for longer. That's creating a situation where we think that sellers are going to start coming around to the new reality, and it's going to create a fantastic buying opportunity where we're going to be able to be buying assets at a net operating income or a cap rate discount that we've not seen for 15 years or so. We couple that with what we think that the outlook looks like. So I talked about how after the Great Recession, a lot of home builders went out of business. There's been sustained underbuilding to meet current demand. Estimates range between 3 to 5 million housing unit shortage nationwide. And with our current rate of building, that's going to take about 7 to 10 years to catch up and to sustain that. The result of that is that there's going to be outsized demand relative to supply for the next decade or so. Additionally, we talked about tariffs. Right now, we get a lot of our lumber from Canada. There's tariffs there. Steel comes from Japan, South Korea, China. There's tariffs all over there. And China manufactures most of our interior fixings, everything from faucets to flooring. All of these tariffs are going to increase the cost of new construction, and that in turn is going to make replacement costs increase. And on the corollary, current assets are going to be worth more because of new cost of construction. Lastly, the current Fed chair, Jerome Powell, has his term set to expire in the spring of 2026, and the expectations are that President Trump is going to be replacing him with someone who might be more conducive to Trump's economic policies, which include a reduction in the Fed rate, which would put downward pressure on interest rates. All 3 of these factors are putting upward pressure on rent revenue, on cost of construction, and overall the asset prices. So this is why we see this as really a golden time of when you can make a deal work, and it is difficult to make a deal work right now, but if you can make it work, you're going to have a lot of tailwind at your back over the next 5 years or so, and now is the time to buy. We have not been more bullish on multifamily in the past 10 years, and we love this as an opportunity. So we hope our group hears this message, and would love to talk with you. As always, book a call with myself or Tori if you ever want to talk, and stay tuned for our next deal. Thanks.